George Soros arrived in London in 1947 with $40 in his pocket and one conviction that most people around him considered dangerously naive. He believed the financial loop he had been born into was not permanent, not inevitable, not reality. It was a structure. And structures, if you understood them clearly enough, could be dismantled and rebuilt in your favor. He spent the next 20 years doing exactly that. And what he built was not just a fortune. It was a private financial architecture, a system where capital circulated inside his own ecosystem, growing and compounding without ever passing through the hands of institutions that would skim the difference and keep it for themselves. Most people never build that architecture, not because they cannot, because nobody ever hands them the blueprint. Today, that changes. There are three specific tools written into federal tax code, recognized by the IRS, used quietly by the wealthiest families in this country, that allow you to function as your own financial institution. To borrow from yourself instead of from a bank. To earn the spread instead of paying it. To keep capital moving inside your own system, the way Soros kept capital moving inside the quantum fund for 50 years. I am going to walk you through all three. Not with a sales pitch, not with jargon designed to confuse rather than clarify, with the mechanism intact so you understand not just what these tools are, but exactly why they work the way they work. Stay with me. This is the most practical financial education most people spend their entire lives never receiving. Here is the mental model I want you to hold before we go any further. Think about how a river moves. Water flows in, water flows out. The current never stops. Now think about what a dam does. A dam does not stop the river, it redirects it. It controls where the energy goes, who benefits from the flow, who captures the value the current produces. The bank is the dam. Every time money moves through your life, your paycheck, your mortgage, your car loan, your credit card, your business line of credit, it flows through that dam first. The bank captures the spread, always, on every transaction, in every direction. What the wealthy figured out, what Soros figured out before he had a single dollar to invest, is that you can build your own dam, not to stop the river, to redirect it, to let capital flow and grow and compound, but have you control the infrastructure instead of a faceless institution. That is what being your own bank actually means. It is not about burying cash in your mattress. It is about building private financial infrastructure that runs parallel to what banks do, except the profits accumulate on your side of the equation instead of theirs. Three ways to do this. Let us begin. The first tool is the one that causes the most confusion, and the confusion is not accidental. When I say cash value life insurance, I know what just happened. Half of you flinched. That reaction is completely understandable. Life insurance earned its reputation problem, honestly, because for decades, commission-driven salespeople aimed this tool at the wrong objectives, structured it incorrectly, and sold it to people who never understood what they were actually purchasing. So let us clear the confusion entirely and talk about what this tool actually does when it is built correctly. The legal foundation is Internal Revenue Code Section 7702, not a loophole, not a gray area. A provision written explicitly into federal tax law to allow certain life insurance policies to grow and distribute money under favorable tax treatment. Congress built it there deliberately. The IRS acknowledges it by name. Here is the structure. You take out a permanent life insurance policy, not term, permanent, and you overfund it, meaning you pay more than the base cost of the insurance coverage. That excess money accumulates inside the policy as what is called cash value. This cash value grows either tied to a market index inside what is called an indexed universal life policy, or through dividends from the insurance company's general account in a whole life policy. Either way, it grows tax deferred, and depending on how you access it, completely tax-free. But the mechanism that changes everything is what happens next. You can borrow against that cash value, not withdraw borrow. This distinction is everything. When you borrow against your cash value, two things happen simultaneously. First, the loan proceeds reach you completely tax-free. You are borrowing against the policy as collateral, not withdrawing the principal. The IRS does not count it as income. Second, and this is the part that deserves a full stop, the cash value inside the policy keeps growing as if you never borrowed a single dollar. Let me say that again because it deserves the repetition. The money stays inside the policy, growing at its full rate. And simultaneously, you have the borrowed capital in your hand, deployed into a separate investment generating its own return. Two streams of return running on the same underlying capital. That is the asymmetric structure. Soros built his entire career identifying where the downside is defined and the upside runs in multiple directions at once. Let us put real numbers to it. Your policy cash value sits at $200,000, growing at 7% annually. You borrow $120,000 against it at a policy loan rate of 4%. You deploy that capital into a real estate investment generating 12% returns. You are earning 7% on $200,000 inside the policy, plus 12% on $120,000 outside it, while paying only 4% in loan interest. The spread between what you earn and what you pay is how wealth builds quietly. Banks run this exact calculation every day using your deposits. Now you are running it with your own capital. Here is the critical warning, and I will not soften it. This tool is massively misused by the people who sell it. Agents earn higher commissions on larger death benefits. Larger death benefits mean more of your premium covers insurance cost and less builds cash value. If you are using this as a banking mechanism, you want the exact opposite maximum cash value growth with the minimum death benefit required by law to maintain the tax advantages. Before you sign anything, look at the cash surrender values in years 1 through 10 of the policy illustration. If you deposit $50,000 in year 1 and the surrender value shows $35,000, that gap went to someone's commission. Work with someone who holds a fiduciary obligation to you. Ask to see the internal rate of return on the cash value specifically. Be skeptical of anyone who leads with the death benefit instead of the cash value trajectory. Used correctly, this is a generational wealth engine. Used incorrectly, it is an expensive lesson in how misaligned incentives work. The second tool is one most people already have access to right now and almost none of them are using correctly. I want to address the objection you are already forming. Why would I borrow from my retirement savings? That sounds like exactly the kind of financial decision that ends in catastrophe. The instinct is understandable. The financial advice culture around retirement accounts has operated on one message for 40 years. Put money in, leave it alone, let it compound, do not touch it. As general guidance, that is not wrong, but it is incomplete because it ignores a specific, legal, tax-neutral mechanism embedded inside most retirement plans that allows you to access that capital without triggering any of the consequences you are afraid of. Here is the distinction that changes the entire conversation. There is an enormous difference between a retirement account withdrawal and a retirement account loan. A withdrawal is typically a disaster. You pay ordinary income tax on the full amount, plus a 10% early withdrawal penalty if you are under 59 and a half. Depending on your bracket, you could surrender 30 to 40% of the money before you deploy a single dollar. A loan is categorically different. The IRS treats it as exactly what it is, a loan. You borrow from your own account. You pay it back with interest. The transaction is never treated as a taxable distribution. The money never left the retirement system. It moved from your account into your hands and back again. The specific mechanics. Most plans allow you to borrow up to $50,000 or 50% of your vested balance, whichever is lower. You typically have 5 years to repay. The interest rate is generally set at the applicable federal rate, currently around 4 to 4.5%. And the part nobody mentions, you pay that interest back to yourself. It returns to your own retirement account. The bank earns nothing. The brokerage earns nothing. Think about what this means practically. You have $200,000 in your retirement account growing at 10% annually. You carry $50,000 in credit card debt, charging 22% interest. You borrow $50,000 from your retirement account at 4.5%. Your account still reflects $200,000. The loan appears as an asset within the plan, not a reduction of your balance. You are paying 4.5% to yourself. You are eliminating 22% going to a bank. That is an effective gain of nearly 18 percentage points on $50,000 compounding in your favor from the first month. When you repay the loan with interest, that interest enters your account and begins compounding toward your future. Your present self is funding your future self. The same dollar is running two jobs simultaneously. This strategy becomes particularly powerful for solo entrepreneurs and small business owners with a solo 401k. The solo 401k is one of the most underused financial tools available to self-employed people. You can contribute significantly more to it than a traditional employer plan, and it carries the same loan provisions. If you are running your own business and you do not have one established, that conversation with a qualified tax professional needs to happen this week. One honest constraint. This works best for short-term capital, needs bridge financing, debt elimination, business startup costs. If you leave your employer before the loan is repaid, the outstanding balance may become due immediately and could be treated as a taxable distribution. Know your specific plan terms before you borrow. But for the right situation, this is fast, low-cost, self-contained capital. No bank required. No approval needed beyond your own plan administrator. Most people do not know this mechanism exists inside an account they have been funding for years. The third tool is where the strategy becomes genuinely sophisticated and where the gap between people who understand how capital actually works and everyone else becomes most visible. Think of it this way. Imagine two neighbors. One keeps all his savings in a single account at a bank. Every dollar he needs, he borrows from that bank and pays interest to that bank. The other neighbor has two entities, a holding company and an operating company, both of which he owns. When his operating company needs capital, his holding company lends it. The interest stays inside his ecosystem. The borrowing entity deducts it as a business expense. The lending entity earns it as income. The bank earns nothing because the bank was never part of the transaction. That second neighbor is running a private credit system, and that is exactly what this third tool builds. If you own a business, an LLC, an S corporation, a C corporation, any closely held entity, you have the legal ability to create a lending relationship between entities you control. Your holding company lends to your operating company. Your capital holding LLC lends to your active investment entity. The interest income stays inside your financial universe rather than flowing outward to an institution. The asset protection dimension of this structure is where it becomes truly powerful and where Soros' thinking about structural positioning applies directly. Imagine you hold capital inside what I would call a safe entity, an anonymous LLC in a state with strong legal protections and no public ownership records. This entity has no active operations, no employees, no contracts, no liability exposure. It simply holds capital. Now you want to deploy that capital into an active deal, a real estate acquisition, a business opportunity. Active deals carry risk, and when things go wrong in active deals, litigation follows. Instead of having your safe entity directly own the active deal, which would expose your capital to that risk, your safe entity lends to the active entity. The active entity carries the risk. Your safe entity holds a secured promissory note with creditor priority. If the deal fails, your capital stands protected behind a legal claim rather than exposed as equity. You separated the capital from the risk structurally. The money is still working, but its exposure is fundamentally different. This is the architecture Soros applied to every position he built. The quantum fund's most profitable trades were not simply the result of being right about direction. They were the result of constructing positions where the downside was defined and contained while the upside remained open. The structure of the position mattered as much as the thesis behind it. To do this correctly, you need a genuine signed promissory note specifying the loan amount, interest rate, repayment schedule, and collateral. The interest rate must be at or above the applicable federal rate, which the IRS publishes monthly. The entities must actually make real payments on the stated schedule with real bank transfers. If the arrangement exists only on paper with no actual movement, the IRS will recharacterize it, and you do not want that outcome. This is not complicated, but it requires discipline and proper legal and accounting support. The cost of that support is small relative to the structural advantage you are building. Two additional instruments deserve a brief mention, because intelligent people miss them simply by not knowing they exist. If you own a home with meaningful equity, you have a dormant credit facility most people treat as emergency-only capital. A home equity line of credit gives you access to low-cost borrowing, typically 7 to 8% in current conditions secured against your equity. But here is what almost nobody considers. When HELOC capital is deployed for investment purposes, the interest is deductible against investment income. The government is effectively subsidizing your cost of capital. The spread between what the investment earns and what the borrowing costs is your return. If you hold a meaningful portfolio of publicly traded securities at a major brokerage, you almost certainly have the ability to borrow against it at rates well below conventional bank loans. A securities-backed line of credit uses your portfolio as collateral. You draw on it as needed. Your positions continue compounding in place. No capital gains triggered. No long-term thesis disrupted. This is how large investors arrive at a closing table with a cash offer in 24 hours secured against a portfolio that kept growing while the deal was closing. Now let me step back and name what is actually happening when someone masters these tools. It is not cleverness. It is not loophole hunting. It is the application of one principle that Soros identified as the common thread running through every asymmetric position he built across 50 years of investing. Capital is most powerful when it is circulating, not sitting. Every dollar sitting idle in a savings account earning 0.5% while you pay 22% on a credit card is moving in the wrong direction. Every dollar you surrender to a bank as unnecessary interest is a dollar that cannot compound inside your own system. Every time you approach an outside institution for capital you could have sourced from yourself, you are giving away a portion of your future compounding to an entity that took none of your risk and built none of your position. The tools in this video: cash value life insurance under Section 7702, retirement account loans, related party business lending, HELOC deployment, securities-backed credit are all expressions of the same logic. Keep the capital inside your ecosystem. Control the flow. Earn the spread. Eliminate the intermediary wherever the intermediary adds no value. I want to be honest about the risks, because the incomplete version of this information is exactly what I warned against at the beginning. Cash value life insurance requires a long-term commitment. The early years favor the structure. Not you. The math works fully only after a decade or more. If you surrender early, you may recover less than you contributed. Structure the policy for maximum cash value accumulation, not maximum death benefit. Retirement account loans carry real consequences if things go wrong. Leaving your employer with a loan outstanding may trigger a taxable distribution. Understand your specific plan terms before borrowing anything. Related party lending must be executed properly. Missing payments, sloppy documentation, or below market rates invite IRS scrutiny. Treat the arrangement with the same discipline you would apply to any third-party transaction. HELOCs use your home as collateral. If the investment fails, the obligation remains. Securities-backed lines carry margin call risk in volatile markets. Never borrow more than you can service comfortably without forced selling. These risks are manageable. They are not reasons to avoid these strategies. They are reasons to approach them with the same clarity Soros applied to every position he ever built, defining the downside precisely before calculating the upside. There is something Soros said late in his career that has stayed with me. He said, "I am only rich because I know when I am wrong." Most people hear that as a comment about humility. It is actually a comment about structure. Knowing when you are wrong requires that you are not emotionally attached to being right. And not being emotionally attached to being right requires that the capital in the position is not functioning as your identity, it is functioning as a tool, deployed precisely with defined exits and defined risk. The three tools we walked through today are expressions of that same structural thinking applied to your personal financial life. They are well established, legally sound, and used consistently by the families who have built wealth that survives generations. The gap between those families and everyone else is not capital. It is not talent. It is knowledge applied with patience and discipline over time. Soros left Budapest with $40 and a conviction that the loop he was born into was not permanent. He rebuilt the architecture from the ground up, tool by tool, structure by structure, position by position. Before you close this video, ask yourself one honest question. Of the 5 tools we covered today, which one is sitting closest to your current situation? The one where you have everything you need to begin except the decision to begin. That is the one you start with. That is your $40. Think carefully, move deliberately, and make your capital work as hard as you do.